Welcome. Thank you for being with us today. Welcome to the Family Office Insights EV Plus Charging Pitch webinar. We're delighted to have Joe back and EV Plus Charging. Sorry about that, Joe. And get into the detail of the ask and the offer and the business. And so super happy to have many of you back from the first webinar, and welcome to all the new participants. And thank you so much for spending with us some of your time today. Super interesting business. I was mentioning to Joe that a friend of mine that maybe 8 years ago wanted to put these in carports in the South, and there just wasn't enough charging vehicles to charge, and that obviously has changed dramatically. And this is a different model altogether, but it's interesting how the populace has adopted the EV, purchasing EV vehicles. So we're super happy to talk more about that today. Just a reminder, we know you're there. If you care to ask any questions, we have a lot of people coming on today, so please post them in the Q&A or the chat box, and we'll get to as many as possible. And if you don't mind, post them as they come to mind, and then we'll answer them in order. And also, as you're reviewing the presentation today, you're most welcome. If anybody comes in mind in your group that or network that would be interested in hearing about this, you're welcome, and we will put you in direct touch to Joe post webinar. And also, we're going to post the recording on the Family Office Insights YouTube channel, and you can review it there, and if you care to do that and share it with others. So again, thank you again for being here, and really delighted that you spend your time with us this afternoon. So with that, Joe, welcome again. Super interesting business. Take it away.
Sure. Well, thank you, everyone. Appreciate your time. I think we've got a couple of people on the call. We have a few of our investors and a few of the people that are in our program that are advocates for what we do. My name's Joseph Schottland. I'm the CEO and the co-founder. Very, very quick background. Prior to this, I spent the better part of a decade in private equity and structured credit, and I focused on real estate, infrastructure, and transportation. And then prior to that, I spent decades as a consultant. I was a senior partner at McKinsey, where I did infrastructure, transportation, mobility, and real estate. The creation of EV Plus is essentially the arrival point of that career, because EV Plus is an electric vehicle charging infrastructure company. So you get the transportation, you get the infrastructure, and we focused on commercial real estate. We've also have Vern Vasquez, our CFO, on the call real quickly. Vern, say hi, and then we'll just jump right into it.
Sure. Hi, everyone. Vernon Vasquez. I'm the CFO of EV Plus. Quick background on me. I spent, about a decade in investment banking, spending most of my time in JP Morgan's mergers and acquisitions team. Afterwards, I spent some time working at various startups, most recently at an auto insurance company, which was acquired by USAA. And since then, I've been the CFO of EV Plus for about a year and a half.
Well, with that in mind, so thank you, everyone. I will try to sum up what we do as in as few words as possible and leave time for questions. Think of EV Plus as a modern era gas station for electric vehicles that does its business on the properties of its clients. Our clients are owners of multifamily properties, hotels, and offices. What we do is we design, we engineer, we install, and we own a self-contained charging business like a gas station, and we put it on the properties of our clients. And in turn, the people who either live in that property, work on that property, or are sleeping in that property use that charging system, pay to use it, and then we share a little bit of the revenue with the property. Think of it as, here is your rent in exchange for allowing us to operate our standalone business on the property. We own everything about it, and we own it in perpetuity. We own the electrical infrastructure, we own the conduit, we own the breakers, we own the chargers, we own everything. We're responsible for maintenance, and all of this is under an extremely long-term contract. That's generally the business. And it's not necessarily a novel business until you understand that we own everything. The difference is that right now in the United States, the way people EV enable their property is they go out, they figure out what electrician to hire. The electrician installs the system that they think they need, and they buy the chargers from a charging company that then in turn, after selling the chargers, makes them pay a monthly fee in exchange for allowing them to monitor the system. We take the headache out of it. We like to consider ourselves the complete brain-free solution. We're like the easy button at Staples. When someone who owns a portfolio of properties decides that they want to EV enable the property, they call us and it's done. We handle everything, and in exchange for this, we turn what is a complicated headache into a passive income stream. The reason it works, as far as a market perspective, is that if you think about EV charging, you have EV charging, EVs, the EV demand growing 30 to 60% per year. And when you look at that and you look at what is required today versus what is needed in the future, the biggest issue with EVs and buying EVs and continuing that growth rate is access to charging. People are scared to buy an EV even though they want one because they don't know if they have ready, stable, consistent, and durable and reliable access to charging. We solve that by putting the charger in their house if they live in an apartment building, or putting the charger in their office when they're there every day, or if they're sleeping in a hotel. What I would also say, without going too far, is that we've been in business for 1.5 years, and what we've done, I've seen a lot of businesses in my land of private equity, and I've seen a lot of businesses in my time as a consultant, is we've done an incredible job in 16 to 18 months. We created a system where we have no salespeople. We have all inbound sales, where our growth rate is astonishing because what we do makes sense to them. We have 230 commercial properties already under contract. We're 50% above our target in our first year in business. We said we were going to do 146. We closed the year with 230. We have a pipeline that gets us to roughly 900 properties by the end of this year. Every property that we sign up a contract for, because it's a long-term contract, has with it inherently contracted long-term profit. We have roughly $80 to $100 million of profit under contract at this point. Every single time we sign a new contract, it's worth on average about $400,000. We underwrite very carefully, and we try to make sure that every profit that we bring in makes its money back in 3 to 4 years. We've designed the business so that even if you think the EV growth is going to slow down, we're still profitable. And if EV sales growth increases or stays where it is, we become a very, very high cash flowing, dividend distributing company. Our customer acquisition model, as I mentioned before, it's all people from real estate. I've spent 20 plus years in real estate. So what did we do? We hired a bunch, not even hired, we brought on people that work in real estate, commercial real estate agents, mortgage brokers, title brokers, engineers. And we said, look, bring us your clients. And in exchange for bringing us your clients, we'll give you a small piece of the revenue over the life of the contract. And what that has done is it has allowed us to grow far beyond what I'd say that our weight class would suggest. We have 50,000 electricians in our network of install partners. We have an installation solution for our chargers. We don't go down. We intentionally design a system that doesn't break, because when chargers break, we don't make any money. And we are very careful about our underwriting, and that's where we are at the 1 year mark. What we're looking for now is $20 million, because we need enough equity capital to get us to the point, and that will get us about midway through 2025. That is enough money, whereas 80%, 85% of it goes towards the CapEx associated with all the installations. It allows us to satisfy the orders that we've already contracted and the orders we expect to get this year. But it also gives us enough runway so that by the time we get to the middle of 2025, we can pivot to more traditional infrastructure like debt financing. Remember, This is an infrastructure play. We are an infrastructure company. We're in the early days of it, where you have infrastructure to support charging, long-term steady income and long-term steady and predictable income streams. And at that point, we pivot the dividend to debt-like financing. Hopefully, this is our last equity raise. And that's the reason that we're on the call with you guys today. What we're looking for are for investors that want a long-term cash flowing investment, but with the upside associated with, call it venture. The valuation of the company, if you look at the public multiples today, someone would say we're worth roughly $150 million. The belief is by the end of next year, the company's worth $500 to $600 million. We have full financials that are audited, or most of are almost completed our audits, because the company was designed from the very first day to be a public company. We're just not ready to pull the trigger yet.
So, Joe, is it fair, if you don't mind me interrupting, to liken this, if it's fair to liken this to a coupon on a capital expenditure, what does that look like in terms of what one could expect on an investment in the company?
What I would say is that if the company was to go public or to have some sort of monetization transaction in the next 18 months, you're looking for a 5 to 10x on your money.
And in the interim, the dividend, not that it would be cash on cash at the moment, but if you put $1 million out into your infrastructure, is it recurring revenue that equates to a coupon that's equal to X? Is that the fair way to look at it?
I'll put that to Vern, who's the CFO, but and I don't want to overstate, but it's it takes us 3 to 4 years per property to come to break even, to recover the cash we've invested on the property. 3 to 4 years. After that, it's all cash. You have continued maintenance costs associated with it. You have monitoring costs, but it's de minimis relative to the upfront cash investment. So it's almost more like a cap rate, Arthur, like a real estate investment.
Yeah, like a cap rate for real estate. Yeah.
You're deploying on a property $50,000 today. That provides enough infrastructure to put 4, 5, 6 chargers today. And then when there's enough demand on the property because the EV growth rate is going like this, we add more chargers to our infrastructure. The adding of the new chargers is cheap. It's the upfront investment that's big to put in all that infrastructure in the ground. Remember, what we do, we install everything, panels, transformers, breakers, conduit. It's all in the walls, it's in the ceiling, and it's in the floors of our clients. We're not going anywhere. But when we want to add a charger in the future, it's pretty easy to add it because all of the baseline infrastructure is already in place.
Yeah.
So the point about having it look like real estate is we deploy this capital. It takes us 3 to 4 years to break even. And then thereafter, every single charger makes how much per year, Vern? Per year, per charger?
Cash flow around $3,000 to $4,000
per year. And you've
per
got
year afterwards.
So what's that translate to in a cap rate? Is it fair to look at it that way?
I haven't done that type of a look at it, but you could think of an extremely high coupon bond.
Yeah, that's what I was thinking. The other thing I wanted to mention, because I dug a little deeper than most on this, is that your business development costs are commensurate with how much business comes in. So you don't have fixed cost of salesmen around, which is super interesting.
We have no outbound sales force.
Yeah.
We are all inbound, and it's fully variabilized. The biggest issue with EV charging companies, one of the biggest ones, and the reasons you see companies like ChargePoint and Blink struggling, is 40% of their cost is sales and marketing. They're out there slinging it. They're out there cold calling people saying, do you want chargers? Let me sell you some chargers. We don't do that. We have some of them on the phone. We have people that work in commercial real estate doing that for us. The head of capital markets for JLL introduces her clients to us. Unfortunately, she's on vacation this week, and she's also an investor in our company. The head of hospitality for CBRE, he introduces clients to us. So we get the benefit of their long-term relationships We come in over the top. We talk to the CEO, the head of asset management. We don't have to compete with everyone who's trying to sell chargers because we came in over the top. And then our solution is so obvious. It's such an obviously better mousetrap than someone saying, okay, I think I need to put chargers in there. How many should I buy? And we buy them and then sell someone a contract for 3 years. That it's a very easy close. One of our investors is even on the call. I'm going to call him out. Steve Carvel, who is he's the professor at Cornell University. Steve, what's your title?
Well, I have multiple titles. Hi, everybody. I'm an investor and a connector for EV Plus. I've been at the Cornell Hotel School for 37 years. I'm also the chair of the finance department at the Johnson College of Business, and I also run our real estate center.
And why did you join us? And I know you're also an investor, but that came later. Why did you do it?
Well, first of all, I believe in the product as an entity. You know, I think this is where the country has to go in terms of electrifying our vehicle fleet. It's impossible to think that it's all going to be solved through public charging stations. As I learned about EV Plus, the platform, which you haven't really spoken about too much, is, I think, competitively a better platform in the way it's designed and the way it's created for owners of both hospitality firms and multifamily, because of the way we do our business, the way that the company does its business.
It's a great point. What I didn't mention is that our client base are owners of portfolios of real estate, and almost by definition, that is not an operating business. That's an asset management business. So our clients are already predisposed to outsourcing operating activities. They outsource parking, they outsource hotel management, they outsource laundry, they outsource telecom, they outsource Wi-Fi, they outsource everything. We are a complex operating activity that has to happen on their property. So it's easy to say, well, let's give it to these guys to outsource. And before we showed up, there wasn't anyone to outsource it to. They had to insource it. So that's been one of the biggest drivers, is that it's the easy button for our clients. And our clients know they need to EV enable their properties. They just don't want to deal with it because it's so small relative to the other things that they are handling as asset managers. And that's been, I think, part of the reason we've had such meteoric growth.
So can we take a quick question? Because I think it's relevant right now. Thank you, good one. Do the chargers work with all makes of EVs? What's the cost of the tenant versus tenant going to a Tesla charger at the mall, for example?
So it's a great question. So no one wants to go to the superstation and hang around for 45 minutes to essentially pump gas in their car. If you look at all the statistics, 80% of charging occurs either at home or the office. And that's because if you have a charger at home, it's so much easier. Wouldn't you rather just go home, plug in your car, go have dinner, wake up in the morning, your car's fully charged? So what do we charge? We know that we're in a privileged position. We are in the places where people want to charge, not where they have to charge. So our pricing is comparable to what you would get in a third party, like a Tesla superstation. So we're not gouging our clients, but what we would say is it'll cost someone $15 to $20 to fully charge their car. Now remember, this is someone who bought a car that when they used to have a gas-powered car, that would have cost them $70 to fill it. Now it's $10 to $15, maybe $20. Does that answer your question?
Yep, I think so. Also, just as a reminder, write in your questions. We don't have the audio functionality here today, so if you have a question, please write it in.
I'll keep going. So this is where
please.
We ended the year with 230 properties. That represents around 2,000 chargers that are committed into our system. Our pipeline, so our clients that we have today are premium names. In fact, we just closed on Noble. For people that know hospitality, Steve, you know hospitality, obviously. Noble is one of the most respected names in commercial real estate and hospitality. We got their entire portfolio. So we'll chalk that one up for this coming year. But we have another, call it 7,000 to 9,000 chargers we'll have by the end of this year, based upon the pipeline. In fact, what I'd say is the pipeline is accelerating because the number of people that are out there, like Steve Carvel, like the head of capital markets for JLL and CBRE, we're getting 2 or 3 additional people every single day. We've signed an exclusive agreement with Keller Williams Commercial. It's a 2,400 agent commercial real estate brokerage firm, and their agents are now out introducing EV Plus as their preferred provider, as exclusive preferred provider of EV charging to their clients. And that's a new relationship with 2,400 additional people that should go out into the market and introducing us. What I had said before, every single property at the unit economics level per year, once these properties are stabilized, it's roughly $6,500 to $7,000 of revenue per charger per year. When you take out the cost of the electricity, you take out maintenance, then the contribution margin to us is around $3,000 per charger per year. Our contracts on average are going to last 15 plus years. That's worth $400,000 to $500,000 of contracted commercial gross profit. Now remember, every single year we add chargers to this property because we're exclusive on them.
Is there a metric that you know of that if there's a hotel as one example or a multifamily unit, how many chargers per population in the building?
Sure. So roughly for every 5, okay, so it's very different for a hotel versus a multifamily or an office. And the reason for a hotel is you have new people showing up every single day. But for a multifamily, it's very easy. Roughly 1 charger for every 4 to 6 electric cars is what you need on that property. So if you have a 600 car parking lot and you've got, let's say you have a 500 car parking lot and you've got 100 electric vehicles on that property, you need 15 chargers to start. But the thing that what we've learned is when you install chargers in a multifamily or hotel, the number of EVs on the property double in 6 months, because the number one,
super interesting, yeah.
the number one reason people don't buy EVs, the number one reason is access to charging. If you solve that by putting a charger in their garage, like in a condo or a rental building, you solve the biggest issue that is the impediment to them buying an EVs. So we like to think that we are helping to enhance the growth rate of EVs. I can keep going. This is a real world example. This was our very first install done in December of 2022. So we call this 13 months ago. It's the Hampton Inn in Yonkers, New York. This is a 150 room hotel, maybe about 15 to 20 minutes outside of New York City. Commuter area, has 150 parking spaces. We installed 4 chargers. It cost us $31,000. There's grant money there, which allows us to subsidize some of the cost. But if you look at the red line, it shows you our break even. Basically, it takes us 3 years, maybe 4 years to get to break even. With the grant money, it's less than 2 years. But what you can see most importantly is look at the gross profit per charger, the bottom line. Once these chargers are stabilized, meaning you've got to 6 hours a day utilization, once you get there, you're getting just shy of $4,000 per charger per year. Again, the idea here is we're creating an annuity stream. It takes us 3 or 4 years to get there, but thereafter, it's just a steady Eddie cash flowing investment. Think of this as like someone who wanted to invest in the cell phone tower business, but just before there were enough cell phones in the gross population to justify it, but you could see the growth rate in the number of cell phones that where people were starting to buy, that you knew it would take 3 or 4 years before all of a sudden, that's it. They become ubiquitous.
Would this be a good time to take a question about competition?
Sure.
So how does this differ from infrastructure companies like ChargePoint and others that provide a similar model, the owner-operated model? And you touched on it earlier, but
It's the right question. So let's pick on ChargePoint and don't hold that against me for picking on them. ChargePoint's core model, 75% of the business is they sell chargers to a company, like a property owner. And after they sell them chargers and they make their money on the sale of that charger, they then make that property pay ChargePoint $20, $30 a month in exchange for monitoring software to manage the EV charging system. So think of this like a SaaS business. They have an alternative, which they would call ChargePoint as a service. And the biggest difference between ChargePoint as a service and what our core business is ChargePoint as a service requires the property to first put in all the infrastructure, do all the design, all the engineering, all the permitting, hire the electrician to install everything, and then ChargePoint comes once everything's ready and they got a plug on the wall right in front of the parking spot. They come, they put the charger on it, and then they charge the property monthly instead of having them buy the chargers. That is the CPO model. That's a great question. The biggest difference is that ChargePoint doesn't own any of that infrastructure. The property owns the infrastructure. In our model, we own everything. We've designed everything. It's a standalone, ring-fenced charging business that operates on that property, and we pay the property a small piece of the revenue in exchange for letting us run our standalone business on the property. That's the biggest difference. It's the easiest, I call it the brain-free solution. Whenever I sit down with hotel owners or sit down with property owners, we take the headache off your plate and we turn it into a passive income stream. And because we own that infrastructure, as demand grows on that property, we just add more chargers. If they went with the ChargePoint as a service, and now they've got a lot of demand, now what do? You got to go back and redesign, re-engineer, re-permit, reinstall to add chargers, where we've done all that on the first day.
And in their case, they're not exclusive to the property. The property owner could decide to take out their chargers and move on, right?
Perfect lead-in point. We have the exclusive right to provide charging services on the property for the duration of our contract. No one else is allowed to put chargers on the property. We're the first port of call. So if that property goes with us and we know that it works, there's no one else showing up on the property. So it's a little bit of a winner take all. And we've had great success in our first 18 months of taking all. In fact,
the pushback on the exclusivity sort of goes away as soon as you say, look, all you have to do is sign here, here, and here, and we'll take all the cost off your hand. You just have to let us be there.
Arthur, the proof's in the pudding.
Yeah.
We do 146 in our first year. We did over 230, and these are big properties. Our smallest property is 100 parking spaces. Our biggest is 4,000 parking spaces. These are not small properties. Our clients are premium names, marquee names in real estate, and it's consistently met with, this is the right answer. This is the right solution. We know it's the right solution. It's a better mousetrap. It's the way that it works in Europe. So if you go to the markets that are more, call it, advanced in the land of EV than the United States, Norway with 71 or 74% EV penetration versus 9% in the United States. In Norway, what we do is the prevailing model. I used to think we were like this brilliant, we came up with this great new concept. Not really. What we came up with was the first person to offer a complete outsourced turnkey EV charging solution for property owners. And then I find out that in Norway, this is what we're doing is the common model.
Yeah. It's like putting a cell tower on a building, right?
Correct.
In some ways. So we have a question about the Hampton Inn as an example. Let me see if I get this right. How many additional charges does the $30K upfront investment in the Hampton Inn support?
Another 4, probably 3, at least 3, potentially 4 more. This property, whoever asked the question, it's the right question. A rule of thumb will tell you that in 10 years from now, roughly 10 to 15% of the parking spaces on a property need to have a charger on them. So if you have 100 parking spaces, you'll need to have 10 to 15 chargers on that property to handle the demand for electric vehicles. What people fail to realize is how fast the EV adoption is happening. Because you hear vibrations in the last couple of months, whoa, the EVs are slowing down. Well, guess what? They sold 1.3 million EVs last year in this country. The year before, they sold 700,000. The forecast that just came out for next year, 1.9 to 2.1 million. Next year's sales, 13% of all cars sold in the United States. This year, 9%. Last year, 5.5%. When you look at the long-term forecast from S&P Global Mobility, from Bloomberg NEF, from Bain, from McKinsey, from KPMG, from all of them, they all did the revisions. They all came out with the same thing. By 2030, which is not that far away, it's 6 years, you have 30 plus million electric vehicles on the road. 30 million. That's 11% of all the cars. So just think of that parking lot that's got 100 parking spaces. You got 11 EVs in that parking lot right now. That's what that says. We're in the right business at the right time, particularly in a land grab. And because our contracts are exclusive and they're so long term, as that growth comes in, it's a little bit of the Kevin Costner Field of Dreams, and you build it and they will come. We are the sole solution because we're providing charging in the places where people want to charge their cars. No one wants to go to the superstation. It's horrible.
So for the moment, this model is exclusively yours, right?
Yes.
Yeah.
Well, it was until about a month ago when Tesla decided they want to do this too. I'll be honest, right? But the world's a big world. So I'll give you an example of how many properties are addressable market. So Tesla has decided to do this with Hilton hotels. But if you don't own a Hilton hotel, you don't have the option. And the world's a big world. So we're not too worried about it. And frankly, what I'd say is that what's my team? Let me find our addressable market slide. Well, let's go back. Here's who we go after. Properties are multifamily hotels and office because 80% of the chargers want to drive there. We have a privileged position because we have our exclusive rights in that property. We focus on markets where we can have the grants and subsidies that essentially reduce our cost of install. So we end up owning infrastructure below the replacement cost because we've gotten someone else to fund it, the government. That will go away. We choose our properties very carefully. So we choose properties that have high use because that gives us a faster payback period. Or we choose properties where the ones they already have, the chargers are already broken. Right now, 20 to 40% of public chargers are broken, called non-functional. There's tons of people that were early adopters and their chargers are broken. And when they call up ChargePoint to fix it, what does ChargePoint care anymore? They sold them the charger. Where's their incentive to go out and fix it?
Yeah.
Now here's our market.
I missed part of an earlier question. Your charging device works with anything?
Yes. You have to. It has to be universal. The best thing that happened was when and people who know the space understand this, was it when all the other OEMs decided to adopt Tesla's standard and harmonized the whole thing as the industry, that makes it easy for us.
Yeah.
So how big is our market? There's 136,000 properties that are at least 100 parking spaces that are either hotels, multifamily, or offices in the country. Of that 136,000, 65,000 of those are in our target states. Of those, 44,000 are in our target states where there's grant money, and they're premium properties where the propensity to charge is higher because there's a lot more EVs on the property. Represents 2.8 million electric vehicles. The market's just enormous. When people ask me how big is your market, it's like how big is a piece of string? Because that's the market size today. 2.8 million EVs on the road. Well, next year there's going to be 4.4 million EVs on the road. Sorry, 4.7 million EVs on the road. And the year after that, there's going to be 7.8 million EVs on the road. So every single year, these statistics get better. But it's a land grab, and the faster we get these properties under our contract, the better off we're going to be, because eventually someone else is going to do what we do. We have the benefit of the first mover advantage.
Sorry about that. Can solar as a roof over a parking lot support EV station? Is there a metric between solar needed to each charging station? Yeah.
Smart question. I don't know who asked it. It's a great question. So I'll start with
Howard, our friend Howard, he's smart.
Howard's a good one. I'll tell you the first thing. It takes roughly a solar array 5 times the size of the parking space to charge a car. So think of it almost like you can have, if you wanted to have a solar powered EV charger, the canopy would need to be 5 times the size of the car, roughly. In a market with, and there's all sorts of things, whether you know that, how much sun do you get, what's the efficiency of the solar array, blah, 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 blah. But that's roughly a nice rule of thumb for you. Our contracts, and no one has fought us on this, our contracts give us the right to install solar and battery storage. We haven't executed it because it's one thing to install charge on the property. It's another thing to tell your client that you're going to put a solar array on their roof. So we haven't really gone there. But in our contract, we have the right to do it.
We have a follow-up question on the Hampton Inn.
Oh, sure. Go back to the slide.
At what point is there a significant capital expenditure required to upgrade electrical service to the property to support additional chargers?
So, sorry, who asked the question?
I think that's Howard. It comes up as
Howard.
but
We need to talk. So let's not focus on the. I'll answer your question for the Hampton Inn, but then I'll answer the question more about the market in general. It just so happens that the Hampton Inn had more power in the building than they needed immediately, so we were able to tap into the existing service provided by Con Ed. Con Ed is the utility in there. So we didn't have to put in a transformer here. We didn't have to get new service from Con Ed. We were able to tap in. We added our own sub panel, and there's a lot of spare power. So right now we have 4 chargers. It'll go to 6 probably in year 2028. So 4 years from now, it'll go to 6 chargers. And then it'll probably go to 8 chargers 2 years thereafter, and then 10 chargers 2 years thereafter. Think about that as almost like the schedule you can imagine of the number of chargers that you add on the property, each charger being worth $3,900 of gross profit. At some point in the future, we will need to add additional service because we ran out of room in the panel, or the amount of service coming into the property is not enough to support it. At that point, that's when we're at the trigger point of having to add new service. We're adding new chargers, but we don't add chargers unless we know we're getting at least 6 hours of utilization out of that new charger, and we do it in buckets of 2. So to make that clear for you, imagine there were 4 chargers on the property today, and then all of a sudden we couldn't get to 6 because there wasn't enough power in the building. If those 4 chargers are running at 36 hours or 9 hours a day each, I know that I can add 2 more chargers for a total of 6, and all 6 are now running at 6 hours a day, because 6 times 6 is 36, 9 times 4 is 36. Math all good? Good. But because I'm getting $3,900 a year per charger on that install, when I have to install that infrastructure, my payback period ends up being 2 years instead of 4 years.
yeah.
When the time comes, Howard, that we have gone past the point where we can support the number of cars on that property in our contract, we have a responsibility to add more power, but we're very happy to do that because we own all that infrastructure. And when those 2 new chargers show up, the contract just extended 10 more years.
Right.
The money back in 2.
I reset. I like it. Yeah.
Nice day.
Yeah.
It's one of the beauties of our business.
So we have a question from our friend Tony. Isn't there a government requirement to have a percentage of EV charging parking spots at some point?
There is. It's not a U.S. government. It's a local. So, for example, in Miami, Florida, under new construction, they'll tell you 10 to 15 to 20% of the parking spaces must be EV enabled. There's not a property even in California in EV Land Central that needs a 20% parking ratio, 20% EVs at this point. No way, not there. Yeah. But you can figure out the math of how many you really need. So in our contract, if it's in a new construction, what we'll do is we'll do someone else's model. We'll let them install that infrastructure and we'll put the chargers on the wall, because we're not going to allow our system to sit and just gather dust for 5 years to satisfy the code requirement of a new construction for some municipality that hasn't really thought it through.
And it's a completely different thing to install the infrastructure in the building process than retrofit it, right?
You've gotten smart. You've gotten smart on this fast. Yes, it is much less expensive because if you look at the page, that Hampton Inn, that building's been around 15 years. We had to trench through the parking lot. We had to cut up all the concrete. We had to drill through we had to core drill through the walls into the floor, into the electrical vault in the basement.
Yeah.
Like the new construction, you don't do that stuff.
Yeah. Just easier.
Just easier.
Yeah.
Yep.
Great.
I can summarize. This is where it really comes to, which is we're the first to market. We've got a better mousetrap. That has already been proven in our first 18 months. We know we have the better solution. The market has validated that. We have a sales function. Our engine to generate new clients has gone viral. And at the point we're adding 2 new people pretty much every day that are out there and selling it. Our client base, they love our solution. They're predisposed to outsourcing. They outsource everything they can. Our client base are owners of properties. They're asset managers. They are not operators. Not an operating business. Deploy capital and earn a return based upon people renting the space. Our lower cost construction, we're cheaper than a property. We can prove it out to you because we buy at scale. We buy panels at scale. We buy chargers at scale. We buy network equipment at scale. And because we have already relationships with hyper-local installers, we can show you data for someone that wants to see it. We tend to be 20 to 40% lower cost than the property if they want to do it themselves. So if someone in some property says, you know what, I want to EV enable my property, they'll go out, they'll get a quote from ChargePoint to buy the chargers, they'll get a quote from their local electrician to do the installation, and they'll turn the whole system on. Let's say the number costs $50,000. Okay, we could do that same job for about $25,000 to $35,000. Why? Scale of our product, scale of our procurement, and 2, when they hire that electrician to figure out how to do the system, that electrician is not an EV specialist. They haven't thought about the smartest way to come through the walls. We end up having more thoughtful solutions on how to satisfy the demand on the property. And happy to show you guys the data. Typically, it's anywhere from 20 to 40% below what they could do it themselves. And the most important point is that we've contracted in cash flow. You just have to wait for there to be enough cars on the property to turn into a dividend producer.
So what's it look like if someone wanted to write a bigger check, could you use it? Would you take it? Do you know?
Anyone, everyone knows this. You're always in the tension for how much capital do you raise versus going the next round at a higher valuation, blah,
Right.
blah, blah. You all know that. For us, it's a little bit different. If you fast forward the clock 2 years from now, then the people that invest in this business are debt providers that want a coupon with a lower rate of return without the business model risk. Because this is infrastructure. This is classic. We're not at the point where you're buying into a toll road. We're not at the point where you're buying into a liquefied natural gas facility. But we're a couple of years away from that. So those investors that want to cut the bigger check, I'm happy to talk to them about it, but we just need enough money now to get to the point where those investors look at our cash flows and say, okay, I'm going to underwrite that. And instead of being equity-like returns, they're very content to take their high single-digit returns, and they have first rights on the cash flow.
Yeah.
Everyone else who's on this call that decides to invest with us, they get the upside associated with the growth of the company.
More like a venture. Yeah. More like a venture investment. Yeah.
Yeah, we're somewhere between steady Eddie cash flow, dividend producing classic real estate and 10x VC. We're right between these two.
Yeah.
Our target investors, Arthur, are typically going to be family offices versus venture capital, and that's a blessing and a curse. On the one hand, venture capital, like software platforms, 6 to 18 months and massive scalability. We are a hard asset business. Sure, we have software, but we are a hard asset business. Family offices that made their money in real estate understand that. They understand hard asset businesses. We are hard asset business, but we have the growth potential of the VC-like software business.
Yes, recurring revenue model,
Mhm.
in many respects, SaaS, subscription type thing. And
Yeah,
I mean, even if you don't really understand or dialed in, it makes intuitive sense that the utilization will increase, not decrease, because we're at a growth curve in, EV acquisitions, people buying cars, right?
Arthur, 9% sales in 2023 versus 5.5% the year before. And the latest forecast that just came out this month, 13% for the coming year. So I know there's vibration about EVs, but you just can't get past the math of that. This is the way the world is going. You just can't.
Listen, let's just call it what it is. Some of that's just sound bites so people can sell advertising on CNBC. That's what's going on there. So our friend Goodrun has another question. How long is the sales cycle for a Hampton Inn versus a multifamily?
The
For
sales
example,
cycle, is that for us to close to win that client, or is that
I believe so. Yeah.
so? No one likes this answer. It depends, but because we come in over the top, meaning we end up the first conversation is typically with the owner of the company. So that Hampton Inn is part of a portfolio of someone owns 10 properties or 8 properties. We met with the owner, we met with the CEO, and they're like, what is this EV stuff? I know I need to do it. Okay, you've come from this guy. We like him, we trust him because he's done all these other things for us. Okay. So we've come in trusted. We haven't gone through an RFP process. We're not in the middle of the organization going through some sort of competitive scrum. We come in over the top. So because of that, our sales cycle's shorter. So I'd say that first one for the Hampton Inn, I don't know, Vern, maybe 6 weeks. 6 weeks.
Max.
They know maybe less. Yeah, they know they needed to put the EV chargers on it. They were looking for someone. They didn't have the bandwidth, the intellectual or the psychic energy that they wanted to apply to thinking about it, and we were the easy solution. And that's how it works almost every time. Now some are longer. We've had some that have gone 6 months. Noble, which is a very large hospitality real estate fund. In fact, they just closed their $1 billion fund, I guess, about a week ago. That's Fund 5. We have all of Fund 4. That took 4 months. And then it's a great question. We actually have some clients that said no. Said, you know what? I like this, but if you're going to make this much money, I'm going to figure I'm going to go do it myself. So they disappear for a few months, and then they come back because the operational brain damage associated with doing this, the customer service and the tech support and on the hook for the maintenance and this deal.
It's too hard. Yeah.
Too much brain damage
Yeah.
for something that generates $3,900 a year per charger when they're thinking about the refi on their $500 million portfolio or
Exactly.
the piece, or this is just small potatoes. And yet they know they need to do it.
Yeah. So that's an interesting point. The 3,900 is your profit.
Yes.
So that suggests that the building would get $1,000 after all done and said.
It varies depending on how much grant money there is.
Right. Yeah.
But that's a fair number.
Yeah.
The IRR for these guys, it's an infinite IRR. They haven't put any money in.
Yeah.
The NOI
Right. Right.
fantastic. And the best part about it, and it's the reason, like I just came back from the largest hospitality trade show yesterday in Los Angeles. And it's the same answer every single time, which is not only do you get the NOI uplift from it, not only is it an infinite IRR, but they get to declare victory that their property is fully EV enabled for green building LEED certification. They get to declare it and they have no CapEx associated with it. None. And if they're thinking about selling that property next year, this is the ultimate greenwashing of the building, because the marketing material says, look at that, it's fully EV enabled.
Yeah, right. It's great. Yeah, I love it. The optics are perfect. Yeah.
Optics are amazing.
Yeah.
They have tenants, and this is real statistics, is that if you're a multifamily and you're in a market where EV penetration is a real thing, and you're not in the middle of, like, I don't know, Boise, Idaho. No, actually, there's still a bunch of Boise, sorry, Alabama. You're not in Birmingham, Alabama, where there's no EVs, right? But if you're in a market where there's EVs, the rent that you can get for your apartment is anywhere from 5 to 10% higher, because if someone has an EV, they are doing a search on where
Only EV. Yeah. Only,
there's
yeah, totally. That makes so much sense. Yeah. Yeah.
we
It's
know, I mean, Arthur, we know we have the golden ticket, but we need to raise the capital to deliver against the orders that we already have and the orders that are coming in at a velocity that honestly I didn't expect us to have.
So the order numbers are impressive. So like so far this year, aside from Noble, you're closing things regularly. So now you have to fund them, right?
Correct.
Yeah. 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 Super interesting. We did have a couple questions of how to get subscription docs, so that's probably a good sign.
Sure.
And the questions are super appreciated. Thank you to the audience. And Joe, you did a great job. Once again, I really appreciate it. And Vernon, thank you for being here. You want to wrap it up a little bit, Joe?
Look, I'll wrap it up in the following. And Vern, if you have something you want to add at the end, please chime in. This is the future of the automotive industry. It's the intersection of commercial real estate and transportation. It just so happens that real estate owners don't realize that they actually are sitting on a real estate that is valued by the transportation sector. And that creates this unbelievable opportunity for us. They just haven't gotten their heads around it yet.
Yeah.
And the sooner we lock up these properties into these long-term contracts, exclusive contracts, we get to declare victory. We get to ride the wave of the EV growth. And if you want to do any digging, I'm happy to share with you guys some of the market research around what the EV penetration growth looks like. It's astonishing. And if you don't have an EV today, chances are that within the next 4 years, you do have one, or you will be buying one, and you'll need a charger. And if you don't live in a single family home and you live in a rental building, or you're traveling for work or for pleasure, you need an EV charger. And we're the only place to go when we're on those properties.
Yeah. And the other thing I think, if this is true, I heard is that, 4 years ago, 5 years ago, the EV vehicle was a high price point. Now that they're coming down, there'll be more people in lower.
All right. Well, I'll give you the stats. Okay. Thank you for the next fabulous lead-in question. All right. Here's the stat.
We didn't rehearse this at all. I mean, just to be clear.
So it used to be that EVs were anywhere from 20 to 50% more expensive than their internal combustion engine equivalent. In November of last year, call it a month and a half ago, it finally hit parity. The average cost of an electric vehicle is equal to the average cost of a gas-powered car.
Nice.
That's all great. Now let's layer on the next piece. To fill up gas in the average gas-powered car, to go 400 miles costs you $70. Costs you $15 in electricity. So when you want to think about mainstream adoption, one of the number one things you want to think about is share of wallet. How much of your wallet are you spending on power? Well, you just took $55 off your weekly power bill for you driving your car around.
Which can be meaningful to a lot of people. Yeah.
Are you kidding? That you talk about mass adoption. That's the first point. The second point is that because of the Inflation Reduction Act, there's a $7,500 credit that you get against your taxes when you buy an electric vehicle, so long as more than X% of the car is made in the United States. And there's roughly 14 cars that qualify for this grant, this tax credit. As of January 1st of this year, that tax credit, which used to be applied towards last year's taxes or next year's taxes, is now usable as a deposit on the purchase of the car. So you're getting your deposit money to buy the EV from the government. So again, share of your wallet. How much of your wallet? Someone else is paying your down payment for you. That's point number two. point number 3, which is how many economy cars hit the how many threshold cars are there for people that don't want to spend $50,000 on a car? The average car in the United States costs $48,000 a year. So how many EVs are there below 30,000, which is called out the economy sector? In 2025, there will be 50 new EVs below $30,000. So you want to know about mass adoption of these cars? It's not going to be 2024. 2024 will be a nice, healthy growth rate going from 1.3 to 2 million EVs sold in the year. It's going to be in 2025 when you have all those new electric vehicle models show up that you're going to see the growth rate just go. Boop.
Yeah, it's super interesting.
So long as the infrastructure is in place, and that's what we are trying to solve.
Yeah.
Put the infrastructure where they want to charge, in their house, in their office, in the hotel parking lot.
Yeah.
Joe, can you go back to the Hampton Inn page? I think
Sure.
it's important to show people, how we're thinking about building commercialization today. So when we think about the Hampton Inn today, payback is 3 to 4 years on installation. If you take the same property and install in year 2024, at the end of 2024 or 2025, if you believe the EV penetration, the way it's going, that payback period on this exact same property is a year and a half.
Yeah. And Arthur, that's because look at the second row. Utilization, because we charge based upon the amount of energy consumed in and out per hour.
Doubles.
In 2023, we were 2 hours a day per charger. In 2025, it's 3.6 hours a day. So you have almost doubled the amount of consumption of power for the exact same system just because of the growth in the EV wave.
Super cool.
Yeah.
Good point. Thanks, Vernon. Wow. Yeah.
Well, I don't know if to say. That's what we got.
Yeah.
Any other questions?
Very well done. I think we're all set for now. If there's somewhat we didn't get, I don't think so. I think we got them all, but we'll make sure everybody's in touch. Thanks again, Joe and Vernon. Thank you. I don't know if Steve's still here, but super interesting stuff. And we'll make sure everybody gets in touch and answer any questions that didn't otherwise have. And we had a request for some subscription documents, which I'm sure you'll be happy to take care of. And then, maybe we'll see you again soon. Either way, we'll make sure everybody gets in touch with you. So Joe, Vernon, thank you. And thank you all for being with us today and spending with us the only thing you can't make more of, and that's your time.
Appreciate it.
Take care.
Thank you.
Bye.